Hello. Chapter 10 is making investment decisions. We're going to break into 3 topics. Identify incremental cash flows, calculate depreciation and operating cash flows, lastly, compute net present value of the project. Capital budgeting is another name for making investment decisions. Typically, given the total capital, for example, $20 million, manager's job is to allocate funds to the projects which will bring in most money. Typically, trade capital is given. We don't talk about how to raise money, which is cheaper. I want to test your knowledge. Do you know which are capital budgeting decisions? Open a new Starbucks at a new neighborhood? Walmart expands online shopping for customers. Honda starts offers zero finance for new purchase. JCPenney considers use more line of credit instead of longer maturity bonds. Which one of the following do you think are capital budgeting or investment decisions? 1, 2, investment. 3 and 4, financing choices. We need some tools to help us make recommendations. In Chapter 9, we learned net present value, IRR, payback, profitability index. As net present value is quite reliable, so this is one of the most popular decision rules in investment decisions. Proposal of a new project comes in, it's loaded with so much information. So what information are relevant? What cash flows should we include? You may see the consulting fees paid to test the demand for the new app, new game. You may see the money set aside for material supplies purchase. Or what if you have empty warehouse? Currently, company is not using it. Can we assign this for a new proposed project? And possibly, sale of electric cars may promote sales of compatible batteries. How about tax? Shall we consider tax at product level or the firm level? A simple rule is to think about the cash flow with or without project. If the cash flow occurs only with project, we call these incremental cash flows. When we evaluate each project, we treat this as a mini firm. We consider the revenues, expenses, and taxes at each level. So this is called standalone principles. Below are a list of common type of cash flows: opportunity cost, side effect, change in net working capital, financing cost, taxes. All of them except for sunk cost belong to incremental cash flows. What is sunk cost? Sunk cost are the expenses already spent. For example, consulting fees for the new product, test on the market, research and development fees. So these will be excluded. I want to think about the example. Suppose you already spent some money fixing the brakes. Now your car is still have another problem. The AC stopped working. So the money spent on fixing brakes is one type of sunk cost. It's not going to affect your choice whether you're going to spend more money, fix AC, or sell your car. We see that in the previous example, there's an empty warehouse. As company is not currently using it, if this is assigned to the new project, should we count it as this free? Or we think that has value? I want to think about examples. Some of you are full-time students, come to the school, take classes. Now you have given up some alternative choices, such as you have fun traveling and have more time sleep or help your family out. or you could get a job, full-time job somewhere else. Although all of them belong to the alternative you have given up, only the one with the highest value is counted as opportunity cost. In the case of warehouse, although currently nobody is using this, and we don't think this is free. We acknowledge it has the opportunity cost. You can simply lease out or sell it. So how do we find out the opportunity cost for this empty warehouse? Should we use the historical purchase price? Or what about the book value after depreciations? What about the market value bid? Someone else willing to pay $3 million for this warehouse. So imagine company don't have any empty warehouse. You have to go out, lease one or purchase one. How much does it cost for you to get a similar warehouse? $3 million. So the answer is C. Company typically have more than one product. So the launch of a new product or service may affect sales of other ones. Depends on whether it's going to increase or decrease the sales. We're going to call these positive or negative side effects. Another name is synergy effect and erosion effect. Let's take a look at some examples. Suppose In-N-Out Burgers decided to add vegetable burger to the menu. Right. So some customers who usually purchase regular burgers will switch to the veg burgers. Apple start to sell iPhone X. This will reduce the sales of the older cell phones. All-inclusive resort offers free credit for spa use, golf uses at the resort. Theme park offer day trip package include transportation and lunch. So the first two are negative side effect. The last two are the positive bundle sales promotions. How you raise your money to fund your investment, whether it's equity or debt, matters. The financing cost will affect the present value of the investment, but we're going to defer this discussion later. Tax is relevant. We do consider tax effect due to depreciation or in the case of asset liquidations. To make sure operation runs smoothly, companies tend to have to support with allocation in the cash account, accounts receivable, inventory, and accounts payable. So these are all belong to networking capital account. Typically, at the beginning of the project, you need more money in the networking capital account. Later on, when you start to operate, sell goods, collect the money back, this account will tend to be freed and fully recovered in the end. Notice that it's changed how much more you are allocated into networking capital matter. Change in networking capital or networking capital spending, not the level. I want you to take a look at two examples. Example 1, at the beginning, time 0, firm allocate additional $5,000 into networking capital. Later on, will be fully recovered in the end. In the example 2, you see networking capital level has up or downs throughout project life. And the change in networking capital will be 10 at the beginning, 40 year 1, 50 additional more in year 2. Then it start to collect back, recover 30 and 70 in the end. In total, although the total spending of negative 100 is fully recovered in the end. Check your knowledge. Could change in networking capital be positive at year 0? Yes. Could you have change in every single year? Possible. Is change always recovered? Yes. So try to think about the change in cash, inventory, accounts payable, accounts receivable throughout project life. In summary, we went over identifying incremental cash flows. All of them except for sunk cost will be counted as incremental cash flow. That's all for today's lecture. Thank you.